And so you got a positive real yield on your treasuries. And so, for example, if inflation is 4%, but a treasury yield, a 10-year treasury yield gives you 7%, well, then you have a 3% positive real yield. And so the opportunity cost of holding a yieldless asset like gold is pretty high, and therefore it's somewhat less attractive. That's basically a strong currency dynamic.
Why they should buy gold, the purpose of buying gold, because as we've examined, gold actually has a very inconsistent track record of hedging against inflation, and it has a almost non-existent track record of hedging against equities volatility. That correlation is near zero. So what's the point is my question.
Yeah, the main discrepancy is that gold is not exactly an inflation hedge. It's a hedge against negative real yields.
Okay.
And so even if you look back in the 70s, the two big spikes that gold had were really during the two periods of time, the mid 70s and then the very end of that period, where negative real yields got down to negative 4%. And so those are the periods where you had that big spike in gold. And for example, if you look at the 1980s, inflation was still running pretty hot, but real yields were positive because Volcker had jacked up the interest rates. And so you could get compensated for that inflation with positive real yields. And so what gold really does is protect you from an environment where inflation is much higher than the bond yields. Mm-hmm. And that's what we've seen over in 2020 is that you saw, gold, over the past couple of years, gold had a pretty big appreciation because it was protecting against that. But now since about, late summer of 2020, negative real yields have been roughly flat. They hit a bottom of negative 1.08% on the 10-year, and that's been kind of choppy and sideways since then, which is why we've seen some consolidation in gold. I do think as you look out a couple of years, maybe in late 2021, I do think that inflation could rise faster than bond yields, especially because the Federal Reserve has some tools they can use to suppress the long end of the curve and keep that submerged below the inflation rate. And if that were to happen, that'd be very good for the precious metals and particularly gold.
Why they should buy gold, the purpose of buying gold, because as we've examined, gold actually has a very inconsistent track record of hedging against inflation, and it has a almost non-existent track record of hedging against equities volatility. That correlation is near zero. So what's the point is my question.
Yeah, so mostly it's a replacement for things like treasuries and other low-risk assets. And so if you look at treasuries, for example, there were decades in time where they were great investments because they paid you a yield that was notably higher than the inflation rate. And so, for example, if inflation is 3% and the treasury is 6%, which it was in many prior decades, you could buy that treasury and earn in a compound a positive real return and grow your wealth. The problem happens is that if bond yields get so low, either due to the Federal Reserve suppressing yields or due to other factors. And let's say you have a 1% 10-year treasury, but inflation's 2% or 3%. Well, you're losing purchasing power by holding that treasury, and it's very unattractive to do so. Now, gold is a yieldless asset, and if anything, there's a slight negative yield because you're paying either security costs or transportation, shipping, all these storage. Kind of frictional, storage. So it's but you can basically call it a zero yielding asset. However, unlike treasuries and dollars, it's a scarce asset, and so there's about 1 ounce of gold per person in the world, estimated by the World Gold Council. And so they're not really making more of it, at least compared to the population growth. And so it kind of has that built-in inflation hedge in the sense that as broad money supply increases over time, gold does gradually appreciate. It just doesn't have these big spikes unless you have these dips in the negative real yield. Okay. And so it's really kind of that protection against periods of time where treasuries are failing to keep up with inflation, which is what we've seen over the past couple of years. And I think we'll expect to see, but not in a straight line. I think we'll still see gold likely do well in the years ahead. So, if you have, say like you're in the 80s, right? So inflation was, pretty high in the 80s, but gold still did very poorly because one, it did very well, in 1980 itself, like at the end of the 70s. So it was in that kind of bear market. And two, because even though inflation was still kind of hot in the 80s, yields were above inflation. And so you got a positive real yield on your treasuries. And so, for example, if inflation is 4%, but a treasury yield, a 10-year treasury yield gives you 7%, well, then you have a 3% positive real yield. And so the opportunity cost of holding a yieldless asset like gold is pretty high, and therefore it's somewhat less attractive. That's basically a strong currency dynamic. On the other hand, if inflation's only 2%, but your yield is 1% on your treasury, well, then you're getting a negative 1% real yield on your treasury. And so even though inflation is not super high, that's a really unattractive. It's unattractive to hold cash. It's unattractive to hold treasuries, where suddenly that scarce yieldless asset looks a lot better. And so that basically, if you look at 50 years of data, gold has quite a strong correlation in rate of change terms with real yields. And so even during the inflationary 1970s, the two spikes where gold did particularly well was when real yields hit their bottoms, and then the periods where gold corrected was also because real yields were rising somewhat. They were becoming less negative. I think it depends in part on someone's investing style. The way I'm approaching it is I kind of have a base commodity producer position, where I'm just kind of buying and holding a big chunk of commodity producers and certain commodities as well, ones that are like say gold and silver, and then around that kind of base position, I'm willing to add some chips to the table, take off chips to the table based on what happens with sentiment and overbought conditions. And so, for example, I was really bullish on copper in the mid 2020, but then we had over the next say 6 to 8 months, everybody was bullish on copper. It was like the most consensus thing in the world, and it went up pretty dramatically, got overbought. Some of these copper stocks really exploded, and even though I think that they probably still have a longer runway ahead, I trimmed those positions because it just became a very consensus overbought trade. And so basically my kind of approach here is to kind of rotate into whatever commodities are kind of out of favor, kind of build up positions, dollar cost average into positions when they're kind of weaken, and then kind of basically take a little bit of profits when they spike, when they go up pretty substantially, when everybody wants them. And so what we saw from 2018 to 2020 was that real yields, based on the 10-year Treasury minus the TIPS market break-even rates for inflation, that's what the gold market follows kind of in real time. And so we saw that fall from 1% to negative 1%, and it bottomed around August 2020. And then even though inflation was kind of heating back up a little bit, nominal yields actually rose faster than break evens. And so you started to get a rising real yield, even though it was from a very low base. It was still negative. It was just less negative than before. So combined with the fact that gold did very well recently, that there's a lot of euphoria around it, gold started entering a correction for several months. Now, what we've seen over the past month or so is that long duration treasuries have kind of flattened out somewhat. They've come back down a little bit, while inflation now is starting to heat up more, and so real yields have gone back down to some extent. They're still not quite as low as they were back in August 2020, but they are headed in that direction. While we've also seen somewhat of a bounce in gold, so that inverse correlation is continuing. And the interesting thing is, as you look at these base effects, if we do get some interesting headline CPI numbers, especially if they overshoot expectations, that could be a decent environment for gold, because it's unlikely that treasury yields are going to be able to keep up with those CPI changes from these base effects. So this is something I'm watching. I'm still long-term bullish on gold here, but basically the timing of that's going to follow what happened with real rates.